We're in the 25 basis point camp, plus 25 basis point in the next Fed meeting, plus 75 basis points in total to come. So the terminal rate is 5.5. We haven't really changed that view. I don't think we're going to change it immediately. I'm not sure that the CPI numbers later are going to matter that much. I think the CPI numbers might have been important for a debate between 50 basis points and 25. I would say 50 basis points is clearly off the table, so it's a debate about 25 or zero, and I think we still come down at the 25 basis points in this meeting.
You're leaning to 25, I get that. But I mean, here what we're weighing is, it wasn't that long ago, pre-SVB, of course, we were worried about the economy running a lot hotter, or hotter than a lot of people had anticipated or expected, right? So the conversation was about plus 50. Now we go to worries about systemic risk in the financial system. So if those numbers come in hot, CPI as well as PPI, again, isn't that going to leave the Fed in a pretty tricky position?
Yeah, look, there's no question the Fed's in a tricky position when they've got two issues to deal with, one inflation and one financial stability. This makes things a lot more complicated. A week ago, we weren't concerned about financial stability, so now they've got two issues to kind of confront. I think they will want to make sure that these two issues in the minds of the market are quite separate, that there's an inflation issue that can be addressed with interest rates, and there are financial stability issues to the extent that they are systemic, and we don't think that they are, but if there are financial stability issues, they can be addressed with macroprudential policies. So they will want to keep these two issues quite separate. The focus on inflation means raising interest rates again by 25 basis points. You're right that there's going to be an economic impact from that. I mean, our forecast for the U.S. this year is 1% growth on an annual basis, but we do think that the U.S. will experience a recession in the back half of the year. So we don't think that interest rates can go from 0 to 5 and there not be any real economic consequences of that. So that's yet to come. That's a shoe that's yet to drop.
Are you expecting the Fed to cut later this year?
No, we think they're going to stay, they're going to raise to 5.5, and they're not going to cut interest rates until next year. So they're going to be well above neutral. Inflation is proving to be sticky. We'll see what the numbers, the latest numbers look like. But services inflation is still rising. So, they'll want to make sure that inflation is firmly getting back toward what their objective is, and we can't really say with much comfort that we're anywhere near that now. So we think that the cuts don't begin until 2024.